Aloha, I'm Stephen Bond-Smith, an economist and assistant professor at UHERO. In this UHERO focus, I'll update you on our latest forecast for Hawaii's economy. It feels good to be a bit more optimistic this quarter. The downturn that we flagged last year is most clearly visible in job numbers, but we believe that Hawaii's economy has now turned a corner, largely because tourism spending regained strength after weakening in the first half of last year. Hawaii visitor spending looks much like the path of US consumer spending overall, and in particular, the dominant role of spending by higher income households. That spending kept US growth above 2% in 2025. And at the same time, productivity has improved. While US growth slipped a little in the fourth quarter due to the shutdown and the uncertainty of the federal tariff policy remains, steady demand and steady productivity kept the national economy from slipping further. And because the continental states are Hawaii's largest visitor market, that resilience directly supports our economy. While we're more optimistic about the US, our international markets remain subdued. Visitor numbers and spending from Canada have continued to weaken in recent quarters, as some tourists hold back from traveling to the United States. There is, however, a small uptick in visitors from Japan, after it previously stalled at about half its pre-COVID level. That's encouraging, but the weak yen makes Hawaii a more expensive destination than it used to be, and that will continue to weigh on Japanese visitors. The most interesting and somewhat surprising development has been the upswing in visitor spending. Visitor spending was up more than 6% last year, with especially strong gains in transportation and in food and beverage. What makes this all surprising, though, is that visitor numbers were down slightly, and hotel room rates were essentially flat. Instead, fewer visitors appear to have been staying in higher-end accommodations and spending more at restaurants, recreation, transportation, and so on. In fact, nominal per-person per-day spending reached a new record in the last quarter of 2025 at $279. But that figure is not quite as strong as it first appears. Now, it's true there has been a recent upswing in spending per visitor, but once we adjust for inflation, real per-person spending only matches an earlier peak reached in February 2013. And it's still about 25% below a previous high set in February 2001, the first year that this data was recorded. However, if we examine real spending per arrival rather than per day, we can go back to 1975. And while there is a recent uptick to around $2,400 per person, the true peak occurred much earlier. In 1988, tourists spent nearly $4,000 per person, adjusted for inflation to be comparable with today's dollars. Because the average length of stay has remained relatively stable, that almost certainly is the true peak in per-person per-day spending too. And while the recent increase in spending is welcome news and it supports our return to optimism in the current forecast, it is not comparable to the higher value visitors that Hawaii once attracted in the late 1980s. The major drag on the Hawaii economy in 2025 was federal employment, down 8% since December 2024, and that weighed on the local economy. But there were a few pockets of strength. The upswing in visitor spending helped add food service jobs, and construction also remained strong, supported by ongoing government contracts. And healthcare continues to expand, reflecting the demands of an aging population. So what does this mean for the outlook? Now, there is some good news and some not so good news. First, the not so good news. The recovery from the mild recession at the end of last year does not mean a surge in job growth. These orange bars show that the employment growth forecast remains subdued. And that makes it harder for workers to find new opportunities. At the same time, weak labour force growth means employers struggle to find the workers with the skills that they need. Hawaii's unemployment rate is very low, but that's not necessarily the same signal of labour market strength that it might be elsewhere. Hawaii's unemployment rate has historically been lower than the national average, reflecting structural characteristics of our labour market, such as the high cost of living, which pushes people to take part-time employment. When the workforce is flat, even modest hiring can keep unemployment low. But it also limits how fast the economy can expand. The good news is that income growth is expected to exceed job growth, suggesting some improvement in productivity. Even so, it returns to Hawaii's relatively modest long-run growth trend. So, Hawaii has moved beyond last year's mild recession, but the recovery is gradual. Growth is returning, supported by a resilient US economy, steady visitor spending, and continued strength in construction. And yet job growth remains modest, population growth is essentially flat, and the long-run path for the islands is still one of slow expansion. The task ahead is clear. Progress in Hawaii comes from improving productivity and raising incomes in an economy that cannot rely on population growth. It is output and income per person that will determine whether or not Hawaii can move beyond slow growth and build a more resilient economy. I'm Stephen Bond-Smith with UHERO. You can read our full report on our website at uhero.hawaii.edu. Mahalo for watching and take care.